Hey everyone, Archana here, back with another day in our financial fitness journey. Today is day 95 of our 365-day life challenge. Yesterday, we explored the magic of mutual funds and systematic investment plans. But remember, even amazing things come with a side of buyer beware. Today, we will tackle risk in mutual funds. Understanding it can make you a confident investor. So, what exactly is risk in mutual funds? Think of it like bumpy road trip you love, thrilling twists and turns, but also potential for potholes. Similarly, mutual funds offer a chance for higher returns, but there is a possibility of your investment value going down. Let's look at the types of risk in mutual funds. The first one is market risk. Let me explain this in simple terms. Imagine you are a big fan of a particular movie style, let's say superhero movies. You buy the latest superhero movie on dividend right after it releases. Let's call it Superhero Fight. You love the movie and think it's the best superhero movie ever made. But a few months later, a new superhero movie, that is Superhero Fight 2, comes out with even more amazing special effects, a cooler storyline, and your favorite actors. Everyone starts raving about the new movie, and hardly anyone wants to watch Superhero Fight anymore. What happens to the value of your DVD copy of Superhero Fight? The price might go down because there is less demand for it. This is similar to what happens with the market risk in mutual funds. Mutual funds invest in a variety of assets like stocks of companies. The value of these stocks can fluctuate, means it goes up and down based on various factors like company performance, industry trends, and overall market sentiment. When the overall stock market goes down, that is called the bearish phase, the value of your mutual fund holding can also go down. And consequently, the net asset value, that is NAV, of your mutual fund scheme, which reflects the market value of all the assets held by the scheme, can decrease. This is market risk. The second risk is interest rate risk. Imagine you lend money to a friend, let's call him Raj. You agree on a specific interest rate that Raj will pay you back along with the money you lent him, which is principal. Now imagine interest rate for similar loans suddenly go up. What happens? Other people can now get a better deal, which is higher interest rate elsewhere. So your loan to Raj might not look as attractive anymore. This could lead people to try to sell their existing loans, like the one you gave to Raj, to get into a newer, higher paying loans. This sudden increase in selling can drive down the price of your loan, the money which you lend to Raj. So, this is similar to what happens with the interest rate risk in mutual funds, debt mutual funds specifically. These funds invest in bonds, which are essentially IOUs from governments and companies promising to repay a loan at a specific interest rate. When overall interest rate rises, the value of existing bonds held by the mutual fund can go down. This is because, as in our example, investors might prefer newer bonds with the higher interest rate. So, the price of older bonds held by mutual funds needs to come down to become more attractive to the investors. The third risk is credit risk. Debt mutual funds invest in a variety of bonds issued by government, companies, and other institutions. These bonds are essentially IOUs, promises to repay a loan at a specific interest rate and maturity date. However, not all borrowers are created equal. There is a chance that the issuer of a bond you have invested in through your mutual fund might default, meaning they fail to make their interest payment or repay the principal amount at maturity. This can happen due to various reasons like financial distress, bankruptcy, or even fraud. The fourth risk is liquidity risk. Now, what is liquidity risk? This refers to the ease with which you can buy or sell units of your mutual fund. Ideally, you want your mutual funds to be fairly liquid, meaning you can redeem your investments quickly without facing any hurdles. However, some mutual funds invest in assets that are traded less frequently. These could be smaller company stocks in small cap funds, real estate investment trusts like REITs, or even some types of bonds, especially those issued by lesser known companies. Here is how liquidity risk can impact you. Exit load. Some mutual funds have exit loads, which are fees charged if you redeem your units within a specific period from purchase. This discourages frequent buying and selling, but it can also make it trickier to get your money out quickly if needed. Mutual funds investing in less traded assets are more likely to have exit loads. Redemption time. Even without exit loads, selling units in a less liquid fund might take a few business days to process. This is because the fund manager might need to sell the underlying assets first to meet your redemption request. In contrast, selling units in a highly liquid fund like a large cap equity fund can be much faster. Now, this risk might sound scary, but here is the good news. You have control. Your risk tolerance, how comfortable you are with potential losses, plays a crucial role. Absolutely. Let's break down these risk tolerance categories with real life examples to make them relatable. The first one is the high risk tolerance. You're like a thrill seeker on an investment roller coaster. Imagine you love adventure rides at an amusement park. You're not afraid of steep drops or sharp turns or unexpected twists. This adventure spirit is similar to having a high risk tolerance for your investments. So, younger investors, typically younger folks in their 20s, 30s, or even 40s, have a longer investment horizon. This means they have more years for their money to grow and recover from market ups and downs, just like you have more time to recover from that crazy roller coaster ride. Equity mutual funds invest in company stocks. Stocks can be like those exciting roller coaster rides. Their values can fluctuate significantly. When companies do well, their stock prices go up and your investment grows with them. But during tough economic times, stock prices can fall and so can the value of your mutual funds. However, with a long investment horizon, you can ride out these temporary dips because the market has historically bounced back over time. The second one is the moderate risk tolerance. You prefer a scenic train ride with occasional surprises. Think of a scenic train ride through beautiful landscape. You enjoy the sights, but you are not looking for extreme thrills. This balanced approach reflects moderate risk tolerance. Balanced funds invest in a combination of stocks and bonds. Stocks provide growth, while bonds offer stability. It's like having both the exciting and calming part of your journey on the trade. Growth with a safety net. So keep in mind that balanced funds aims to offer a smoother ride compared to pure equity funds. While you might not experience the extreme high of booming stock market, you are also less likely to face the steep drops. This balance makes them suitable for investors who want some growth potential but also prioritize some stability. Now comes the low risk tolerance. You seek a relaxing boat ride on calm. Imagine a peaceful boat ride on a tranquil lake. You value a smooth journey with minimal bumps. This calmness reflects a low risk tolerance for investments. For these kind of the investors, the priority is capital preservation. Debt mutual funds invest in bonds issued by government and companies. These bonds offer regular interest payment and return your principal amount at maturity. They are like your reliable boat too. You might not get the high return of the stocks, but you have a lower risk of losing money. This is especially suitable for retirement and capital protection. People who are nearing retirement or those who prioritize protecting their principal might prefer debt mutual funds. These funds offer a steady stream of income and are less volatile, making them ideal for those seeking stability over high growth. Remember, this is a simplified overview. It's crucial to consult a financial advisor for personalized advice based on your specific requirements and risk tolerance. Let's navigate the investment journey together, one informed step at a time. Many mutual fund providers offer online tools to help you assess your risk tolerance. Take advantage of these resources, and that's it for today. So, we'll keep exploring the exciting world of mutual funds in the coming days. Stay tuned and happy investing. The link for our upcoming webinar on 18th of April is given in the chat box. Click on that link to register yourself for that. This webinar will be in Marathi and please invite your friends.